Analysts are saying it's time to add Wendy's into your portfolio. Are they right? That's exactly what I'm going to be analyzing in this video. So smash that like button and subscribe if you're new. You're watching More Money. Let's get it. What's up, guys? So over the weekend, I was reading an article on Barron's where it said that Wendy's shouldn't get a frosty reception from its investors. And here's why analysts believe that the Wendy's stock should be a buy. So they started by saying that, first of all, Wendy's shares are down 7% this year. And that makes a lot of sense. There's a lot of things that investors are worried about, which could be headwinds towards fast food or just restaurant operators in general. And you see they have it listed out right here. Investors are skeptical of restaurants in general. Inflation is pushing up food and labor prices at the same time that gas prices have spiked and consumers have become habituated to eating at home. Those are all very good points. But that being said, take a look at this second point here where it's saying that Wendy's is an accelerating growth story and is priced at a significant discount to its peers, which could mean that it might actually be oversold. But I just want to point out that during the pandemic, you can see in this next chart here, you can see in 2020 that the US fast food market did contract, which makes a lot of sense because there were a lot of lockdowns happening and people were eating more at home. And even in 2021, you can see that the US fast food market didn't return back to the 2019 levels. And it won't really be until 2022 or really even 2023 where the fast food market really returns back to where it was pre-pandemic. But that being said, if you look at the 2021 to 2028 numbers, essentially what this chart is saying is that we got some market effects here of the overall market growing at approximately 4.5% into 2028. So there are some tailwinds for the industry as a whole here. Now, that being said, I wanted to pull up McDonald's figures for you just to show you how they were impacted by the pandemic. So you can see here in McDonald's, and the reason why I'm pulling up McDonald's is because they mentioned McDonald's specifically in the article, but you can see here for McDonald's, their revenues actually did decline in 2020, which actually was a bit of a surprise to me because you guys remember I was doing Uber Eats on the channel, and one of the most commonly requested Uber Eats items was McDonald's. I always skipped those orders, but you can see it's very interesting that in 2020, the revenue actually declined by almost 9%. And as you can see in 2021, it just ratcheted right back up 21% in 2021. And now looking into 2022, you see how there's an E beside the 2022 date. These are estimates. So the analysts are estimating that it'll grow 5.3% in 2022 and another 5.5% in 2023. So they're expecting that McDonald's is going to grow at slightly above what the overall fast food market is expected to grow at. So not bad for the burger chains. I don't think that the burger chains did as bad overall. And just comparatively, here's the interesting part. If you look at Wendy's, you can see that in 2020, they actually didn't decline in sales. And I think part of that might be that they probably increased pricing, but they also introduced new products, and the number of stores that they were opening up in the back half of 2020 probably helped them accelerate their revenues to the point where they got a little bit of growth there. But you can see in 2021, they had some huge growth with 9.4%. In 2022, they're expecting 10.3%. So that's double on a percentage basis what you would be expecting for McDonald's or what the analysts are expecting for McDonald's. So you can see here why the analysts are more excited for Wendy's, where it's trading at a lower valuation, but in the near term, they see higher growth. So I can understand why they would write this article. And then in 2023, you can see the growth comes way down to around 5%, which is effectively in line with where they expect McDonald's to grow at as well. Now, going back into the article, you can see that some of the headwinds that people are worried about with McDonald's are not actually impacting Wendy's, because one of the fears about McDonald's is that they have so many locations opened up in Russia, which they may have to close permanently, where Wendy's, 95% of the businesses are just domestic. So their 2022 guidance calls for system-wide sales growth. Now, that being said, McDonald's, the analysts are expecting system-wide sales growth for 2022 as well. I don't think the restaurant closures in Russia are very material to McDonald's if you're expecting overall 5% revenue growth. So I don't know if this Russia risk is really a big risk for these fast food restaurants. So I would almost dismiss what the article is saying here. But I think the real point that the BMO Capital Markets analyst is saying here is that the rate at which Wendy's is expected to grow is accelerated from the rate that they've grown historically. And so that's actually pretty interesting because that'll impact the way that we're valuing it. And you'll see my valuation afterward. But moving on to this next slide, you can see something interesting, and I didn't expect this. Now, when you have high food inflation, you would think that, okay, fast food's going to get more expensive, and so people are probably going to eat at home more to save money. But the opposite is kind of happening, where Wendy's and their peers have raised prices in the face of inflation, and the company's most recent results show that it hasn't hurt their profits at all. And I think when you look at these fast food operators comparatively, because Wendy's is more focused on value, like the value menu. I know McDonald's does have the value menu, but I personally think that the Wendy's value menu is much better. But so when Wendy's is focusing on the value menu, it should allow it to grab greater market share in the second half of the year when more and more people are feeling the pinch of inflation. I actually do believe that the article is right here. But that being said, don't count McDonald's out here. This isn't their first rodeo. They, of course, will beef up that dollar menu if they see that they're losing market share to their competitors. So I think that this is a moving target, and maybe Wendy's might be able to grab market share early on, but I don't know if they maintain that market share if McDonald's sees it happening and they decide to hone in on it. But one interesting thing for Wendy's is now introducing breakfast, which is really important for them. It's now 7% of their system-wide sales, and it climbed 10% year over year. And so I find that very interesting for Wendy's because for a long time, McDonald's has really dominated that breakfast market. So it just provides the consumers with another option. And so that absolutely will grab market share. The other thing is, and this is what I think is very important, Wendy's has started a new partnership with a delivery-only ghost kitchen company, Reef, which is another huge catalyst. Now, this is what McDonald's is doing wrong. When I was doing Uber Eats, I would decline McDonald's orders because the people that were ordering McDonald's were not tipping, so I just didn't bother. But the other reason why you would want to decline McDonald's orders is because you would have to wait 20 or 30 minutes in that drive-thru just to make $3 to $5 for that order. Well, if you're only able to do 2 orders an hour, well, now you're making under minimum wage at around $6 to $10 an hour. So that's why you completely avoid McDonald's. However, anytime you went to any of those ghost kitchens, and there's so many ghost kitchens around Toronto at least, you would walk in, the order's ready for you. They're made specifically for Uber Eats and DoorDash and whatever. So you walk in, you ring the bell, you got your order. They even gave you popcorn for free, which I thought was cool because I'd nibble on some popcorns while I'm doing the deliveries. But there was no waiting. And so that changes the game. Because if I can walk into a ghost kitchen, pick up 2 or 3 McDonald's orders at a time, and then deliver those, well, that $6 an hour quickly turns into 12 to 20 plus tips. So that changes the game. So I think Wendy's is making a big move here. And I think it's going under the radar because a lot of the Wall Street analysts or whatever, they haven't done Uber Eats. I don't know if they really understand the market from the perspective of a driver like I would have, just because I did the 250 deliveries. So I can see some big increases for revenue in this market. And I like that they're getting more aggressive on digital because digital is not just mobile ordering. It's incorporating incentives to keep your customers coming back. Now, that being said, McDonald's is also doing this, but I just like the fact that they're getting into this. Now, what I wanted to share with you guys next is back to that whole ghost kitchen thing. Look at how much delivery orders increased as a result of the pandemic. Look, delivery was already increasing, but look at how it spiked up during and after the pandemic. So this is a big deal for restaurants. Now, I would say from my conversations with the restaurant owners, they're not seeing a huge contribution margin from these delivery orders because they are seeing so much of their revenue being eroded by the fees. That being said, it still keeps sales going. Even if they're making a fraction more per day, that could add up over the years. So I don't see the food delivery apps going away. The only thing I see is that there might be a race to the bottom in terms of fees. And so the restaurants win from this. So we'll see how that plays out. Now, back to the article. Looking at spending data from the 2007 to 2009 recession, it shows that overall restaurant spending can be fairly defensive as consumers cut at other categories. And so far, consumers are proving resilient in the face of more pain at the pump. And so what I would want to say there is, I think what the benefit that you have with fast food restaurants like McDonald's or Wendy's is that people might cut higher priced restaurants and come down into the market for these fast food restaurants, for example, like for their lunches. And so all the customers that you may lose who were already at the Wendy's and McDonald's levels who are now brown bagging it, you're going to make up for them for all the people that come down the price chain. So I think that's why you're kind of seeing that these burger chains are relatively resilient during inflationary environment. Now, that being said, they finished the article by saying that free cash flow is one of the best ways to value these restaurants. And according to their metrics, Wendy's, who has higher near-term growth prospects, to a point I would like to add, is trading at 18 times free cash flow compared to 25 times free cash flow for McDonald's. So on a relative basis, Wendy's is cheaper. That being said, I made a full model for my Patreons, and you guys can get access to all of my research at the $5 per month tier. And if you really wanted to and you felt inclined to, I love having these monthly calls where we go over all the research that we're seeing. We talk about option strategies, we talk about different investment strategies, and we also talk about different names that would be important to value and build models on for the subsequent months. So you guys are more than welcome to join the Patreon. The link is in the description below. And just as an example, I do want to show you one of the unique things that you do get on the Patreon is because we have all these companies modeled out, you can see that every day the tickers are updated, the prices are updated with, I think it's a 15-minute lag. And we have our valuations updated for those companies. And then what you'll be able to see is the valuation as a percentage of the price. So you can see here that we have some companies that their current share price is around 30% of the price. And you know, the second one down on that list, that 34%, I've blacked them out because I only want that information to be available to the Patreons. But you guys can already tell that that second name there is Alibaba. And I personally believe that $100 per share, Alibaba should be valued at somewhere around the $300 per share range. So, of course, Alibaba's trading at 34% of what its true value is. But you can see that there's other names there that are trading at less than half of what they're worth. And so the Patreons get access to this every day. And every day the list is moving up and down depending on what the current share price as a percentage of its valuation is being reflected. So it's completely updated. The Patreons can download this and download every single other model that comes with it and make adjustments as they deem fit to the models to adjust the value that they perceive to give to each company. So that's what I wanted to make a quick plug on what the Patreon at the $5 tier gets to you. But now let's move into the Wendy's valuation. So you can see here that at a 17.5 times terminal multiple, I'm valuing Wendy's at around $19 per share. The current share price of around $22, $23 per share is higher than where I'm valuing it at. So although on a relative basis, Wendy's is cheap compared to McDonald's, I don't think Wendy's has a high enough margin of safety that I'd be looking to invest in it. Now, that's just on a valuation perspective. There's a couple of things that I do want you to be concerned about. The first item is here. You can see that cost of goods sold, the reason why the cost of goods sold is low right now is because they're passing on those price increases to the customers. But is there a point where that higher pricing cannot get passed through to the customer? And in that case, those margins won't hold up. So that's one risk overall. Now, I've made the point where I do believe that as people move down from restaurants to fast food chains, you'll probably be able to keep some of that. But that being said, we are entering into an unusual environment right now where inflation is now getting into the high single digits, and we could potentially see it in the low double digits. So does that mean that these fast food companies overall lose sales? It's really a wait and see on how that happens. Now, that being said, if we are in a higher inflationary environment and rates are going up, as Chairman Powell did come out today and say that he might have to increase rates at a more aggressive rate, then do I really want to be investing in a company that has a debt to free cash flow in the low double digits? Now, I understand that it's projected to be 8.9 times. That's not because the debt levels have gone down. In fact, they've pretty much stayed the same since 2015, as you can see from the highlights. So what's really happening is that their free cash flow is going up, but I don't want to be investing in a company that has a high amount of debt right now. So for the reasons of their valuation not providing a huge margin of safety and the debt levels being high, I don't think I'm looking to invest in Wendy's anytime soon. But that being said, I won't invest my portfolio, but I will invest in ruining my diet. You guys let me know what you think, which fast food operators you think are worth buying. And in the next video, I am going to call out 2 restaurants that I think are trading really close to 50% of their intrinsic value. The Patreons already have access to those names. So stay tuned. If you haven't subscribed to the channel, now's the time to subscribe so you don't miss out on that video. And also guys, when you subscribe, hit that notification bell so you absolutely don't miss that next video. Also, if you guys haven't seen the latest video that I have on Alibaba, you can get to that video right here.